Okay, guys, if you've watched any of our videos, you know I talk about the three long-term metrics of stock market valuation: the 10-year cyclically adjusted PE ratio, the price to sales ratio, and the stock market to GDP ratio, which is often called the Buffett Indicator. And you can Google it and find it in all places. I was sick of Googling it. I just wanted my own version, so I created my own version. I'm not doing total market index. I'm doing S&P. To me, it really doesn't matter what you're using as long as you're using a market cap based index. So don't use the Dow because the Dow is effing useless. I believe that either like Russell 3000, Wilshire 5000, or S&P 500 are the ways to go. Now, I pulled data going back before the S&P 500 existed based on Shiller's going back in time saying this is what the S&P 500 would have been based on the companies were there, etc. So I pulled GDP data and S&P data going back to 1929. And the GDP data is quarterly going back to like 1945 and then yearly before then. So the bottom line is, here's all the data right here. Okay, so it's pulling here, etc. Now, I took the stock market, S&P current, the value, and where it was at that point, the GDP, and created my own ratio. Basically divided the S&P index by GDP and multiplied that by 10 to get some sort of ratio. The average over the last almost 100 years, 93 years or whatever, is 0.881. The highest was 2.069. Ironically, the very first year of the index in 1929, and the lowest was 0.33, which was in 1982. Now, here's a couple things I want to point out. If it's in red font, it means it's overvalued. This is the ratio. This is how much over or under it is. If the cell has pink to it, it means it's really overvalued. It's over 1.33 times. If the cell is just red, it's between equal value and 33% above. And if it's green and then highlighted green, same thing, but reversed. So here's the interesting part. We're currently at 1.438, and I'm factoring that based on June's GDP being the same as September, which is probably not. GDP in September is probably higher, but it's 1.438. Last year hit a peak of 1.923. And again, this is for the quarter ending, so it could have been higher during the middle of the quarter. Here's the interesting part, 1.438. Just remember that. Here is the 2000 tech bubble. It started in March of 2000. Look at the number here, 1.461. Today, we're at 1.438. The highest level that a lot of people say we never, guys, this is after falling 25% of the S&P and 30% of the NASDAQ. We're a little bit better than we were at the start of the bubble burst, at the start of the peak turning down in 2000. That's how crazy it is. Let me show you guys something else. Look at the red font, overvaluation. Today, the last time it was at value or below was September of 2012. That is 10 years exactly of overvaluation. All right. How long was it overvalued for? From June of 08 until 2012. Let's go look at the tech bubble. It was only overvalued. Look at this. Based on history, from September of 96 to September of 01. That's 5 years. We've been in overvaluation for 10 years. That was 5 years. Look how long we were undervalued for. Based on history, December 1969 until September 96. That is 27 years. Now keep in mind, the average for this index would have been a lot lower back then. Let's see what it was before the undervaluation started in 1969. The average going back to the 1929 was an average of 0.972. So it probably would have been a lot less months here of undervaluation. Maybe not a lot less, but the point is, we had a long time of undervaluation, a long, long time of it. And look at now, we've had a long time of overvaluation. The pendulum swings. Now, what's the reason why this could be wrong? One, inflation really skyrockets GDP. Because remember, when they report negative GDP now, that's real GDP. That's after subtracting inflation. So for example, if GDP nominally was up 3%, but inflation was 6%, it's minus 3%. It's 3% minus 6. So it shows negative GDP. But you got to look at nominal GDP levels. Because look, June of last year, we had $22.74 trillion in GDP. June of this year, almost 25 trillion. That's almost $2.5 trillion more of GDP. But yet we talk about this recession and GDP is down. Well, it's because of nominal versus inflation. Inflation drives down real GDP. So that's something to remember. So if GDP is if inflation is 7% a year and we just match have zero real growth, so only 7% nominal, GDP doubles in 10 years. That's one way in which this index comes down. But what's the easiest way it comes down? Price. Price falling, as you've seen, can fall fast. From August 25th until now, I think the NASDAQ was down like 20% or 17%, something crazy. Probably going to be some sort of combination of the two. Am I saying we're going to get to levels of 1982 where this metric was literally 0.329 in June of 1982? And I believe the absolute low point of that bear market was August of 1982. So 2 months beforehand, 2 months after this metric. That would mean we're at 1.4 today and the low was 0.32. Stocks are at the fall. What is that? So four times 1.28, a little bit 4.5. We have to fall by from 3,500 down to 800 or something like that in the S&P to get to that same valuation metric. That's crazy. Now, does that mean we're going to go there? Not necessarily. It doesn't mean anything is possible, but all I'm saying is my job is to look at us today. Where do we stand today relative to history? Well, we stand at the same point today that we stood in March of 2000. That was the peak of the dot-com boom. March 10th of 2000 was the absolute top of the NASDAQ. That was the peak, and that's where we are today after falling 25%. So what does this mean? It means if you think the market was rational in the last year and fairly priced, you are bona fide stupid. That's just it. You're absolutely stupid. Is that okay? That's absolutely okay. I'm okay with that. But just don't dilute yourself into believing that overvaluation is a different story this time. It's absolutely ridiculous. Does that mean that we're going to go to 1,500 the S&P? No. But what it means is the future outlook of stocks based on where we are today is not good. And you should exhibit more caution. People were euphoric. People were crazy. People are saying now, oh, the fear out there. There's no fear out there. What's the fear? It's more fearful than it was 2 years ago? Okay. But there's no fear out there. You don't know what fear is. Fear is, I want out of stocks. I don't care at what price, get me out. And that will happen again. It's happened before 3 times in the last 20 years. That's the point of fear. Fear is when people are saying stocks are going to zero and there's no good news out there. That's fear. That is fear. Somebody going, oh, this sucks. My blah, blah, blah stock is down 40%. That's not fear. Stocks have a long way to go. And I don't care if you're a value investor or not. Stocks are going to go down. Whatever stocks you own will probably go down. So you might sit there and say, well, what's the point of owning? Great question. Only 7% of my money is invested in stocks. And I have a big short position in the market. So do I have a bias? Sure. But I enter that short position because of my evaluation of the market. But right now, the way it looks for the future is the returns of the next 10 years are not going to be anywhere close to the returns of the last 10 years. Is it possible it's different? Absolutely. Absolutely, it's possible. Is it probable? No. And that's what we're here to do. We are the batter at the batter's box, and our job is to hit the best pitch we can. We avoid pitches in the dirt. We avoid high pitches inside. We pick our sweet spot. We know our sweet spot, and we swing at it. And your sweet spot should be when stocks are lower. That's the hardest time to do it because that's when fear is its highest. But if you think about it logically, when fear is at its highest, it's because stock prices keep going down. When they're going down, it's because of fear. And is the fear ever, our extremes are never really rational. When nothing can go wrong, that's not rational. When nothing can go right, that's not rational. You've got to be aware of that. That's why on this channel, we teach the adage of the more you understand, the less you fear. If you understand what happens with the emotions and the mentality and the process of the market that you need to have, you will fear things less, like I do. Do I still have fear? Come on, absolutely. I'm still a human being. Of course I have fear. I have stocks that are down 40%. The difference is my stocks that are down 40% are now a better buy than they were before. The Palantirs at 40, the Pelotons at 180, the Workhorses at 40, or whatever all these hype stocks were that I was right about. Yes, have I been wrong in a few stocks? In the short run. But then again, that's like saying that Cathie Wood was right until February of 2021. No, she was wrong. Her process was wrong and broken, and now it's playing out. And over the last 5 years, you've had zero returns for ARK. It's literally, as of this morning, it was selling for a lower price than it did 5 years ago because her process was garbage. And my guess is ARK will probably end up being lower by the end of this cycle. When is the cycle going to end? I have no idea. And anybody who guesses anything about a certain date is wrong. And just because you're making bets in the future doesn't mean you're trying to time things. Timing things is saying, on this date, this is the best time to do it. This morning, I made a trade that was absolute perfect timing. It was luck. It was pure luck. The market was down 2.5% in the NASDAQ. I sold covered puts on my short position, and literally right then and there, I got a price, and in an hour, the market was up, the NASDAQ was up 1.7%. I exited that and got 60% of my profit that was supposed to take me 1 month. I got it in about 1 hour. Out I went. Okay, do you see me sitting there saying, look how good I am? No, I just sat there and, hey, good timing. I probably would have made that money over the next month, but I happened to get lucky and made 60% of it in 1 hour. Okay, great, awesome. And I'm gonna do it again at some point in the future. But guess what? When I do it in the future, it's not gonna make it for me in 1 hour. It's probably gonna take a month to do it. Okay, don't confuse luck with skill, right? Now, one thing I will tell you, you go back and look at our videos. I have stocks that are down, but my stocks that are down tend to be good cash flowing businesses with bright futures and good established cash flow and earnings. The ones that I said were all hype and stupid that have fallen since then, that was a different story. I look at Palantir. I just did a video the other day. Palantir is not the price that makes sense to me. Peloton, it was at $9 or $10 recently. It still doesn't make sense to me. It went from 180 to 9. That's a 95% drop. It still made no sense to me. So I don't buy it. That's what that's what being an investor is understanding what drives the value of a stock. Understanding here what drives the value of the market, and that's this. GDP at any given time is going to show you the value of the market. So if I believe in the US economy, which I do, my goal is to just buy when stocks are low. That is my goal. And as stocks go lower, I will start buying into stocks more and more. But when stocks are below value, you'll see me literally selling my soul to get money to put in the market. And I will be on this channel saying the next 10 years are probably going to be good. And there will be people saying, you're an idiot. You don't get it. The world is falling apart. And I'll say, okay. And that's what being a value investor is always looking wrong. And I'm okay with that. But on this channel, what I'm trying to do is teach the right mentality, the right emotion, and the right process. But the two most important ones are emotion and mentality. If you just have those two and you buy long-term ETFs, you will beat the market. Because you'll invest more when times are lower and you'll be okay when times fall. But if you have a great process and don't have the emotion and mentality, you're screwed. You're not going to beat the market. You're probably going to do really poorly, even with the right process. Because emotion and mentality is the number one most important thing when it comes to successful investing. And that's why I do these things over and over. I want to repeat in my head over and over the right things to do, because if I know the right things to do over and over, it'll seep into me and I will understand it, and my mentality and my emotion will be more consistent because of it. If you watch 4 or 5 more of our videos, I guarantee you will walk away with a better understanding of money and investing. So you do need to do that right now. Subscribe to the channel, watch our videos. We have over 1,800 videos there. Thank you very much for your time. Don't forget to subscribe. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?